Hello everyone. I hope you're doing good mentally and physically fit and fine, guys. So, in three lectures, we have covered a lot. We have covered chapter number 1, chapter number 2, chapter number 3, and we started with chapter number 4 also. So, today, let's cover maximum number of questions. So, we are looking into very interesting set of questions, the way Institute is drafting it, and then when we are understanding what are the key points to hit on. If you watch these lectures on repetitive basis, you go through these questions, you will become very comfortable with them, and we expect a lot of coverage from these questions. Only the thing is, it will be redrafted, reconstructed. We are going to see that. You are going to see a lot of reconstruction of the questions. That's for sure. So your interpretation skill should be good. I hope you are loving it, enjoying it, guys. Keep liking, keep sharing it with everyone. We are taking a lot of efforts to make these videos, to take these lectures on daily basis, to deliver so much of content in the less time. Again, a lot of efforts are required. And as lecture ends, do put your lovely comments. We love it a lot. So don't forget to do that. Okay. So, guys, let's start with where we stopped yesterday. Yesterday we started with chapter number 4, and we saw few questions. We saw few questions of chapter number 4. Now, let's see. Let's see, guys. Question 40.100. Question 40. Question 40.100, and that is about identifying, assessing risk of material misstatement response to risk. So this question is taken because it has been repeated a lot of times at different places. In exam, it has come a couple of times. So while commencing the statutory audit of Alex Company Limited, what would you consider as auditor to assess risk of material misstatement and responses to such risk? So guys, they're asking two things. They are asking two things here. First, they're asking, what will you do to assess the risk? What will you do to assess the risk? Okay. And then they're asking, what is going to be your response to risk? What are you going to do to assess the risk and then response to risk? So we have two parts of the question. The first part of the question will be as per SA 315. If you recall, if you remember, when we talk about risk assessment procedure, so risk assessment procedure is very simple. Risk assessment procedure is nothing but collecting information and obtaining understanding. Collecting information and obtaining understanding, so that with the help of this information, we are able to identify and assess the risk. In fact, the last part of the risk assessment procedure, you can say, is identifying and assessing risk. So once you collect information, you are supposed to think what can go wrong. That is identifying and assessing risk. So here we are supposed to explain. That risk is at two levels. And we are supposed to explain what we do in identifying, assessing risk. Okay, let's see, guys. So it's pretty simple. So what you see in blue is a summary. What you see in blue is simple summary. It's a simple summary, guys. So simple summary. So first you need to explain that risk is identified at two levels. One is financial statement level, and then next is assertion level. Okay, what is financial statement level? When the risk is of such a nature that misstatement can happen, and in any part of the financial statement, misstatement can happen in any part of the financial statements. Okay, any part of the financial statements, then it will be called as a financial statement level risk. So for example, company shifting from AS to Ind AS, so all the accounts are getting affected. Misstatement can occur in any part of the financial statement. That is a financial statement level risk. Suppose a new software is implemented, there will be migration from old to new. Anywhere there material misstatement can happen. That is a financial statement level risk. Suppose the account head is not having good knowledge of the accounting policies. Any policy can go wrong. Again, that's a financial statement level risk. Suppose accounting software is malfunctioning. Anywhere things can go wrong. Again, there is a financial statement level risk. Management is not having good integrity. There are integrity issues. Anywhere things can go wrong. Again, there is a financial statement level risk. So one is financial statement level. One is financial statement level, and next is assertion level. When you know exactly, when you know exactly in this particular financial item at this particular point, things are going to go wrong. That is called as assertion level risk. So first explain that risk is identified two level: financial statement level and assertion level. Now, then you explain what exactly you do in identifying assessing risk. We do four things. We do four things. We do four things in identifying assessing risk. So what are these four things, guys? It's very simple. What are these four things? So as soon as we get the information, we get the information about the economy, we get the information about the industry, we get the information about the entity, about the governance structure, their operating style, their business practices, whatever information we get, we have to think what can go wrong. We have to think what can go wrong. We have to identify what can go wrong. If the industry is in the slowdown mode, inventory can become obsolete. Debtors may default in payment of money. So there are ideas to think about it. What can go wrong? Okay, inventory can become obsolete. This can go wrong. Okay, next, debtors are going to default. Okay, this is going to go wrong. Identify. Then think about it. Which assertion you must be aware. Okay, we are going to. Okay, let's quickly. What do you mean by assertion? All the information which management gives through financial statement directly or indirectly. All the information which management gives through financial statement directly, indirectly, everything is called assertion. That's a broad meaning, very broad meaning. All the information which management gives through financial statement directly, indirectly is assertion. That's a broad meaning. Now in financial statement, there is a three type of data: transactions, balances, and disclosure. Three of it: transaction, balances, and disclosure. So directly, indirectly, what information is given by transactions, that's called assertions of transactions. Then directly, indirectly, what information is given by balances, that's called assertion of balances. Directly, indirectly, what information is given by notes to accounts, okay, that is assertions of presentation and disclosure. So when we come to specific meaning, there's a three type of data, and each data directly, indirectly gives some information. That's called assertion of transaction, assertion of balances, assertion of disclosures. Okay, a quick example. Suppose let's talk about assertion of land and building. Suppose land and building is 100 crores. So directly, indirectly, they are saying it is real existence. This is only land and building. There is no other land and building. Completeness. Amount is correct. They are saying directly amount is correct. Valuation. And it is in our balance sheet. That means we are the owner. Rights and obligation. For assets, it is rights. For liability, it is obligation. So there are only four assertions. There are only four assertions for balances. That is assets and liabilities. So think about it. Which assertion can go wrong? Which assertion can go wrong? Okay. Then think about it. Is the risk whether a lot of assertions can go wrong, where the whole financial state, many assertions can go wrong. Many assertions can go wrong in financial statement. Think about it. Is it a financial statement level risk? Then next you think about what is the likelihood, probability that misstatement will happen. What is the likelihood, probability that misstatement happen? And also think about the magnitude. What could be the amount? Okay, let's freeze, guys. Let's freeze. It's very simple, straightforward. So question asks about identifying and assessing risk. How you identify and assessing risk. So it's very simple. We identify and assess risk at two levels: financial statement level and assertion level. So there are four steps involved. After we collect information, we think about it. We identify risk. We think which areas, which item can go wrong. Then we think which assertions can get affected. When we identify a particular assertion, we'll get assertion level risk. Then we think whether many assertions are getting affected, whether a lot of financial items are getting affected, it will become financial statement level risk. Then we think what is the likelihood and magnitude of the misstatement. If likelihood and magnitude is very high, is very high, it will become high risk of material misstatement, guys. Okay, so 4 steps are involved in identifying and assessing risk. Now let's talk about this, guys. Response to risk. So SA 315, SA 315 explains us how to identify and assess the risk. Then we have SA 330, which tells us what should be a response to risk. What should be a response to risk? What you should do? What you should do once you get the risk? Okay, guys, let's see. Now, response for risk at financial statement level. If you get financial statement level risk, that means anywhere things can go wrong. Anywhere things can go wrong. In this case, what we do, we go for overall response. What do you mean by overall response? We don't know exactly where things will go wrong. We go for overall response. What do you mean by overall response? Okay, so we'll have a bigger team. Overall response, we'll have a bigger team. We'll have more seniors in the team. We'll have more experts in the team. We'll call the team and tell them, increase your professional skepticism, include surprise element in your audit procedures, and we'll do more supervision of this team. Now this is called overall response. That means making your team strong. We don't know exactly where things will go wrong, so we make our whole team stronger. More people, more seniors, more experts, call them more skepticism, more surprise element, more supervision. Then what if you get assertion level risk? What if you get assertion level risk? If there is a assertion level risk, guys, we go for further audit procedures. We go for further audit procedures. Okay, further audit procedures. What does come in further audit procedure? Two things come in further audit procedure. We go and check internal controls. We perform test of controls for that particular assertion. We go and perform test of controls for that particular assertion. We go and check those internal controls which are protecting that particular assertion. There can be a control protecting existence. There can be a control protecting completeness or valuation or rights and obligation. We go and check that internal control. Then after that, we perform substantive audit procedures for that particular assertion. Okay, and we keep increasing nature, timing, extent of our procedure as per the risk involved. More is the risk, more are the audit procedure. Very simple. So that's how we explain. If there's a financial statement level risk, there's an overall response. If there's an assertion level risk, we go for further audit procedures, that is test of control and substantive audit procedures. Substantive audit procedures. When we talk about substantive audit procedures, two things come in that: substantive analytical procedures and test of details. Okay. Then further they are explaining, it's very simple. More explanation for that. Always consider the reasons for the risk. Always consider reason. If it is due to high likelihood because of the nature of the item, okay, what is the exact reason? For example, cash. For example, always understand the reason why this risk is there. Whether this risk is there, why this risk is there. Whether this risk is because of complications. Because of complication, risk can arise. Because of judgment issues, risk can arise. Because judgment issue, risk can arise. Because of pressure, risk can arise. Because it's very easy to sell an asset. Is it easily movable, marketable? Risk can arise. Always understand the reason. You will understand the root cause of the risk, and accordingly you will be able to understand which controls are relevant, which can compensate it. For example, if inventory is easily movable and sellable, then physical controls become very important. They become relevant because that can compensate the risk. Always understand the root cause of the risk, nature of the risk. Then only we will be able to understand which control should be tested and what substantive audit procedure should be there. Okay. Finally, higher RMM, more risk. Let's freeze, guys. So first question was how you identify and assess risk, how you identify the risk and assess risk, and what is the response. It's very simple. First, explain risk is identify and assess at two levels: financial statement and assertion level. Explain the 4 steps of identifying the risk. Then response. For financial statement level risk, we go for the overall response. For assertion level risk, we go for further audit procedures. That is test of control, substantive audit procedures. Then you explain that. Always understand the root cause of the risk. Then only you will be able to decide and perform proper audit procedures. And you should be responsive. As risk increases, procedure increases. Let's freeze, guys. Let's go next. Okay, okay. So, November 23 mock. November 23 mock. You have this question. November 23 mock, you have this question. Now, this question is not exactly as per standards and auditing, but these questions are important, guys. You cannot ignore it. You have to give importance to it. Enterprise risk management. This has been there in old November 23 mock. It is an old question. They are talking about enterprise risk management. So moment student see a one page answer. Moment student see one page answer there. Oh my God, one page. So much I have to rectify. So much I have to. So much I have to cram. I will help you guys. Don't worry. Don't worry. Don't worry. Don't worry. I am there. I will help you with a beautiful answer, beautiful analysis, easy to understand, easy to remember, easy to write. Okay. So first, they are focusing on two things. Let's talk about that. They are focusing about ERM, Enterprise Risk Management Program. So they are first, they want to say that, don't know, understand this ERM, Enterprise Risk Management Program. It's a quite a wide program. So first, the whole thing about ERM is quite, it is quite a broad program, wider program. It covers lots of different risks. It covers lots of different risks, different range of risks it's covering. It is covering, it is taking into consideration external risk, internal risk, all different factors. For example, it's going to consider what risk can occur, what risk is there because of the industry issues, industry matters, because of competence, because of governance, because of strategy, because of performance monitoring, and so on. It is considering a lot of different types of risk. So what is the when we talk about economy, whether there is a risk of recession, what will happen because of that? In industry, is there a lot of competition? What will happen because of that? Whether there are a lot of regulations, so there is a legal risk. What will happen because of that? In governance, there is a family involved. What will happen because of that? Machines break down. What will happen because of that? Labors. What will happen because of that? So when we talk about enterprise risk management, it's a much broader concept, wider concept. Loads of different risks are covered. Internal, we take into consideration risk because of external factors, internal factors, example of those factors. But then when we go for traditional internal control systems. Okay, now guys, listen carefully. You must have seen the definition of internal controls as per SA 315. So SA 31 says that as an auditor of financial statement, we are generally interested. In four types of controls. As auditor of financial statement, we are interested only in those policies and procedures of the company, okay, which are there to achieve four objectives, which are there for four things. So policies and procedures for legal compliances, law is the foremost most important thing. Then below that, policies and procedures for safeguarding assets is the next important thing. With the help of assets, you go for operation. Policies and procedures for operations efficiency and effectiveness, and after operations happens accounting. Policies and procedures for financial and operational reporting. So let's understand this, guys. So as per SA 315, auditor of financial statement is focusing on auditor financial statement is concerned with only those controls, with only those policies and procedures which are focusing on legal compliances, safeguarding of assets, operations efficiency and effectiveness, financial and operational reporting. Okay, so they want to say that enterprise risk management is a much broader concept. A lot of factors are covered, a lot of different risk is covered. On the other hand, internal controls is comparatively it's a narrow concept. It focuses only on four things, whether these four things are achieved or not. So first message they want to give, ERM is a broader concept and internal control framework is comparatively a narrower concept. You also explain these 2 points. You first explain about ERM, then you explain about internal control, traditional internal control framework, and it focuses only on four things. Okay, so and then you talk about critical components, and then you talk about critical components of ERM. So what we exactly do in ERM? First thing we do is risk identification. We make a list. We make a list of what are the different types of risk, which affects the organization. As I said, different types of risks which affect the organization. Whether there is a recession which affects the organization, or competition in the industry, or technological developments, or the governance issues, regulatory issues, or within the company breakdown issues, breakdown risk, or employee risk, operational risk. What are different types of risk? What are different types of risk which affects the organization? So critical components. First we do is we identify, we make list of potential risk. Then we set the assessment criteria. We set the assessment criteria, how we are going to assess risk. Whether it's going to be in percentage, whether it's going to be in percentage, whether it's going to be in points, or whether we are going to say that, okay, it is a low level, medium level, high level, this kind of risk. Okay, whether it is going to be quantitative criteria for measuring the risk or qualitative criteria for measuring the risk. We decide the criteria. Then as per criteria, we start assessing the risk. Okay, so we start assessing what is the regulatory risk, what is the probability that penalty will be imposed on us, and how much will the penalty will be imposed on us. So we measure legal risk. Then we measure how much employees can steal. Okay, so that operational risk, we compute operational risk. So as per the criteria, we start assessing the risk and start putting them on a graph. As per their likelihood and as per the magnitude involved. Then looking at the graph, looking at the map, we prioritize the risk. Okay, this risk is a very big thing. Technological risk is a very big thing. If technology changes and we are lagging behind, it can kill our product and finish off everything. So technology risk is the first level. Labor risk is the second level. We prioritize the risk. Then we define key KPI, key performance indicators and key risk indicators, and use lot of data and metrics. We collect loads of data and we keep analyzing. What is the performance of the organization, what is the sales, what is the dispatches, what is the production, what is the number of hours labor are working. Key performance indicator, key risk indicators, how many cyber attacks are happening, how many customer complaints are coming, how many show cause notices are coming from the regulatory authorities. Key risk indicators we define. These are performance indicators, these are risk indicators. Then we collect loads of data and keep monitoring them. We compare ourselves with the others in the industry. We keep benchmarking, we keep comparing ourselves with the others and find out whether we are less risky entity or more risky entity. So there are two frameworks. So for enterprise risk management, a detailed discussion and guidance in given different types of framework. They are talking about two frameworks: COSO framework, Committee of Sponsoring Organization, COSO framework, and ISO, International Standard Organization 31000. Guys, it's more than enough. We have explained this. It's a lovely thing. Otherwise you would have taken half an hour, 1 hour to understand it and to remember it and cram it, and it will be disaster. So it's very simple. You first talk about the ERM program, it is a broader thing. You talk about the internal control framework, it is comparatively a narrower thing. You talk about the critical components, right from identification to benchmarking. It is in a logical sequence, guys. So we have worked, we have done research, it is in a logical sequence. Okay. Let's see, guys. Lovely questions we have seen. Now. It's a very, very beautiful question, lovely question. It is from the study material, new study material. It is application oriented. So what is happening is that company is making quarterly budgets. Companies making quarterly budgets, that in this particular budget, this is the target. So much of revenue should happen. So much of revenue, so much of expenses. So much of revenue should happen, so much of expenses should happen. This should be the performance, and then they're comparing with the actual. So this comparison is being done, and whenever there's a difference, they investigate it, they find out the reason, and they rectify things, they correct things. Okay, this division is not performing properly. Let's talk to them, let's improve their performance. Okay, this cost is overshooting, let's control it, and so on. It's a lovely thing they are doing. Now they are saying what they have done, they are making quarterly budgets. For all the departments. They are comparing with the actuals. They are calling the department heads. They are asking for the justification why there is a difference, and then they are asking them to make the corrective action, timely corrections, and so on. So they're saying identify and explain component of internal control. Alluded means hint. Alluded means hint that from this what which so this complete process hints about this process hints about which component of internal control. In yesterday's lecture we saw components, guys. We saw components of internal control framework. Okay, guys, let me tell you one thing, because I keep saying this lecture is exclusively for South India students. Those who are comfortable in English. When it comes to Hindi, we have a session at 11 o'clock. Okay, now let's see, guys. Now they are saying, so this particular example is related to which particular component. We have already seen there are 5 components of internal control. The most important, how serious TCWG management is towards internal control system. That's called control environment. And are they having internal risk assessment process? That is risk assessment process. And are they defining control activities? Are they creating and implementing control activities for the risk? So control activity is the next component. Are they monitoring internal controls on regular basis? Okay, that's the next component. The last one, to support all of them, you need very good information system and information technology in the company to ensure that all the components are working properly. Okay, now, so they are saying this particular example is related to which particular component. So guys, it is related to the control activity. It is an example of a control activity. So first you need to explain that there are five components. Just write the name. You give a reference of SA 315. You give reference of SA 315. Then you explain there are 5 components. Then you explain that one of the components is called control activity. Some of the example of control activity, like wherever there is a high value transaction, risky transaction, there should be segregation of duty. There should be authorization process. There should be record keeping. After record keeping, there should be reconciliations. There should be regular review. There should be regular performance review. All these are examples of control activity. And this example is exactly called performance review. Making budgets and then comparing what was expected and what is actually is happening, comparing them, finding out the difference, asking for justification, asking for correction. That is called as performance review. Performance review is an example of a control activity in an organization. So you give reference, you explain components, you explain control activity, give some examples, and then explain that this is a performance review. Definitely, you explain case study, complete case again, and then explain it's a performance review. So this example is giving hint of a control activity called performance review. So again, beautiful question. So such kind of question was not there earlier. Such type of question was not there earlier. So it's again very interesting, guys. Very interesting. Now, let's go, guys. Next. So, audit procedure in response to exception reporting. Again, it is from the study material. Now, let me tell you, guys, this was not exactly a question. This was not exactly a question in study material. In study material, they gave a situation and then they gave audit procedures, but it was highlighted. As per my experience, I know that when such kind of things are, the very high probability that they may come in exam. So let's understand what they're saying. They're talking about exception report. So our internal control systems on regular basis make some report that's called exception reports. That means these reports highlight unusual things which are happening in the system. For example, they may highlight assets with zero depreciation. They may highlight negative inventory balances. They may highlight branches with negative cash balance, and so on. Here, there is an exception report. Exception report generally highlight unusual things, and here it is highlighting there are purchase entries without purchase orders. There are 40% purchases. without purchase orders. That means there are purchases, purchases are done, but there is no purchase order. That means purchases are done without approval. Purchases are done without approval. Okay, without approval, purchases are done. Now, that is crazy. Without approval, purchases are being done, uh, and some of the purchases were validated, approved after the actual purchase. After the actual purchase. And there's one more issue: no reconciliation between goods received and goods ordered. So no reconciliation also, how much goods were ordered and how much goods were received. So there are two issues. Purchases are executed without purchase order, that's a big problem. So it is unauthorized, they are unauthorized purchases, invalid purchases, that's the problem. And then there is no reconciliation at the end, how much was ordered and how much was received. So these are the two issues which are there. Okay, so what they have not, they simply discuss. So they drafted it and simply discuss what it is. So what are we supposed to explain? So first you explain that any situation or circumstances where we think that internal control is missing, which is required for preventing, detecting, correcting misstatement, or they are not properly designed, it is not operating effectively, it is a deficiency. So you explain that this particular situation shows that there is a deficiency in internal control system. You first explain what do you mean by deficiency. You first explain what do you mean by deficiency, and then you say that okay, this is an example of a deficiency. Then you explain the nature. Now this deficiency, you explain the nature. This deficiency is affecting a particular item. This deficiency is affecting only purchases. It is affecting only purchases. So nature, it is account level deficiency. It is account level issue. Okay. Then you explain it is affecting purchase account, it is affecting creditors. So you explain, okay, this situation is a deficiency, it is a deficiency, and this deficiency is triggering the control risk also. It is a account level thing. Purchases and creditors, these are the accounts which are affected. How are you going to check it now? What kind of audit procedures will be performed to check it now? So they're explaining. The most easiest, do inquiry. Go and talk to people. How come there are purchases without purchase order? Go and talk to them. How can this even happen? Okay, whether the approver was absent, he was not there, there was a vacancy. How come this is happening? Go and ask loads of questions. Why there is no reconciliation? Go and ask a lot of questions, ask for explanation. Are they having valid explanation? So a lot of explanations may come. People were not available, person resigned, systems were not working, and a lot of things will be there. So first easiest thing is to go for inquiry. Next is you go and see, the most important thing in purchases is to have genuine and reliable good vendors. So go and check vendor listing. Whether vendors are registered after following a proper stringent process. There is no invalid vendor entry. There is no unauthorized, unapproved, invalid vendor entry. All are approved vendors. It's very important, because if the vendors are approved, then the chances of manipulation, chance of fraud reduces drastically. So the easiest thing is first to go into inquiry, then do research, then do examination of the vendor listing with the terms and conditions, everything is appropriate. Then you select some purchases, go and check through PRN documents, quotations, purchase orders, GRN, where the things are tallying with each other. So very simple audit procedures they are talking about. Easiest one is inquiry. Little more efforts is to go and examine the vendor listings. Little more effort is to go and do vouching of the purchases. Let's freeze, guys. So this was not exactly the question, but then the way it is there in the module, it can be asked. So very simple. So they are just giving you example of deficiency in the purchase. Explain it is a deficiency. Explain the nature. It is account level deficiency. Account level effect is there. Explain the accounts getting affected. Then give simple audit procedures. Because everything in the module is important, guys. Everything is in the module is extremely important. It may be asked in the exams. Guys. Come on. Now this question is a legend in itself. This question is a legend. This question is a legend, guys. Now this is talking about risk-based audits. What are the phases in risk-based audit? What are the general steps in the risk-based audit? What are general steps in risk-based audit? They keep asking this question again and again and again and again and again and again. Okay, so in the our titanium book, there's a concept MRI.180, MRI.180. Come on, let's come to that. Let's come to that. So, so we are supposed to explain what is risk-based audit, what are the risk-based audit, what happens in risk-based audit. It's a pretty simple thing. Our whole, okay, just a minute, guys. Let's see, guys. Risk-based audit. So there are three phases in risk-based audit. First phase is risk assessment. Go collect loads of information. Go collect loads of information and identify and assess the risk. Find out the complicated areas, judgment-based areas, pressure-based areas, okay, and find out where material misstatements can happen. Those areas are marked as risk assessment. So the first phase called risk assessment phase, where the ultimately we want to identify and assess the risk. Next is the response phase. Well, next is the response phase. Depending on the type of risk, we go and perform the examination. That is the response phase. And finally, we have the reporting phase. Finally, we report. Finally, as per the audit findings, we report. So it is pretty simple, guys. Risk-based audit is the most simplest thing, because it is explaining whatever we do as per standards on auditing. Whatever we do as per standards on auditing, there are three phases involved. But then it is bulky, guys. It is bulky. So if you see, it is damn bulky, guys. So there are three phases. There are three steps. First, they explain three steps, and the same thing becomes three phases. Then there is a risk assessment. Then response to risk. Then there is a reporting. It becomes bulky. Now this is where I come into picture and I ease it out. So first three phases, then now it's in a flow, guys. Understand what happens in risk assessment. So when client comes to us, we carefully, in risk assessment, first as client comes to us, we carefully think where to accept the new assignment, where to continue the old assignment. So we think about it first. We think about it, whether to accept. Then after accepting, we sit and we do planning carefully. We make audit strategy and then make audit plan. Okay, in that, the first thing after planning, the first thing we go for is risk assessment procedure. We collect loads of information, obtain a lot of understanding. Okay, and the last, you can say the last phase in risk assessment procedure, the last thing we do is we go for identifying and assessing the risk. We think carefully what can go wrong, which assertion can get affected, whether a lot of items can get affected, financial statement risk, what is the likelihood. Once we get the risk, we think about the relevant controls which compensate a particular risk. They are called relevant controls. For example, there are chances that poor quality purchases may happen. So when goods come, a quality check is done. So the step of quality check, the procedure of quality check is a relevant control for us. It is a relevant control for us. So that in that particular step or procedure, that means that particular control which exactly compensate the risk is called relevant controls. And then during this process, if we come across any deficiency, we communicate to management and TCWG as per SA 265 that we came across some deficiency and we want to tell you this deficiency so that you can rectify the situation, improve the situation. See, guys, it's in a flow. So in identifying risk, what we do in this initially as client comes, we think whether to accept or not. Acceptance and continuance. After accepting, we go for planning, strategy and plan. Once we make the plan, we go for risk assessment procedure. The last thing we do in risk assessment procedure is identifying and assessing risk. Once we get the risk, we also think about relevant controls which are going to compensate this risk. And if we come across deficiency, we are going to communicate it to TCWG and management. See, lovely flow. This will help you in retaining. Things. Okay. If you go in this flow, if you're having this book, great. If you're not having, don't worry. Simply go and do the numbering. Simply go and do the numbering in your own book. You can go and do numbering in your own book. Flow is important. Then response to risk. Okay. Response to risk, it's pretty simple. We have already discussed. In fact, we just discussed, if there's a financial statement risk, we go for overall response. If there's an assertion level risk, we go for further audit procedures. So the purpose is very simple. The purpose of this phase, this step is to go and perform further audit. For financial statement level risk, we go for overall. See, it's absolutely fine if you write something extra. Okay, don't be finicky. Don't try to match each and every word. That's not required. That is not required. So simply explain in this particular phase. In this particular phase, if there's a financial statement risk, we go for overall response. We make our team strong. If there's an assertion level risk, we go for further audit procedures. Further audit procedures simply means test of control and substantive audit procedures. Test of control and substantive audit procedures. That's what we do. Okay. That's what we do. So I will say that I will re-change the numbering. Purpose is pretty simple. Once you get the risk, you have to respond. You have to perform audit procedures. So I will say that this is 1A and this is 1B. I am obsessed with numbering. I want to club points logically so it's easy to remember. Okay, when we plan our response to risk, we keep in mind certain things. So when we decide the audit procedures, we keep in mind certain things. So we aim at USA. Okay, so we keep in mind assertions. We keep in mind what kind of assertions we want to check, because depending on assertion, audit procedures are going to change. We keep in mind internal controls. Okay, so we know that if internal controls are good, it's going to reduce a lot of our efforts. So if we see that the internal controls look reasonable, acceptable, we perform more test of controls and reduce our substantive audit procedure. So we keep in mind assertions which we want to take. We keep in mind that test of controls are going to be very efficient. A lot of efforts are going to be saved. We keep in mind management override. If we think there's a potential management override, then we are going to do less. Then we are going to rely less on internal controls, because management can override them at any moment. We are trying to keep things aim at USA unpredictable, more unpredictable. People will not be able to conceal things, hide things. Okay, good for us. If there's significant risk, we have special audit procedures. Significant risk is the highest level of risk. We have special audit procedure for significant risk. We try to use analytical procedures also. So it's very simple. When we plan our response to risk, we think about aim at USA, we think about assertions, we think about internal controls, we think about management override, we think about unpredictability, we think about significant risk, we think about analytical procedure. So that is point number 2. And point number 3 is going to be very important. This one is going to be very, very important. Why it's going to be very, very important? Because there's a case study on this later on. So first we perform test of controls. See, in risk assessment, we find out, this is the inherent risk, this is the control risk, this is the risk of material misstatement. In risk assessment, we have rough idea what is the control risk. Then we go and perform test of controls. That idea further gets clearer, whether controls are operating effectively or not. Finally, we go for substantive audit procedure. This is the sequence in which things happen. First, we go for risk assessment, then we go for test of controls, then we go for substantive audit procedures. Once we perform substantive audit procedures, there is absolute clarity. Okay, there's absolute clarity. Then we get absolute clarity whether there are misstatements, whether there are misstatements or not, and it tells us ultimately how good are internal controls. Once we go with all these 3 things, we finally understand how good are internal controls. So then we make a final assessment about internal controls. Are they reliable and low control risk, or they are not reliable and high control risk? Okay, so before concluding, confirm the control risk assessment based on substantive procedures and evidence obtained. For deviation from accounting internal controls, make quick inquiry for implication. If deviation indicate the preliminary assessment isn't supported, and amend it unless control test supported. Modify planned substantive procedure if the control risk assessment need revision. So what they're saying very simple thing, that listen guys, in this particular step, after risk assessment, we perform test of controls, and then we perform substantive audit procedures. So they are saying, go and perform test of controls. Go and perform test of controls. You may come across deviations. That means internal control systems are not followed. Sometimes internal control systems are not followed. There is deviation. Sit down and understand what is the rate of deviation, how much is rate of deviation, whether controls are reliable or not. Okay, and then try to understand whether we were considering this as a strong control, reliable control, and whether our assessment is changing, whether our assessment is different from what we were thinking, what our preliminary assessment was. So we'll have to change our assessment and change our control risk, and maybe have more substantive audit procedures. Then we go and perform substantive audit procedure also. If we get misstatements, it indicates that controls are not operating effectively. Again, our assessment is going to change, and we will find out the final control risk assessment. Let's freeze guys, the last point. After there is a after we go for risk assessment, after we have a preliminary control risk assessment, we go for test of control. Okay, so this is about TOC. We go for test of control. We may come across deviation. We analyze that, study that, and depending on that, we may conclude that okay, our preliminary control risk assessment was not appropriate. Final risk assessment is so and so much, and change substantive audit procedure accordingly. Our risk is not low, our risk is high. We need to perform more substantive. Then we go and perform substantive audit procedures. We may come across misstatements. Again, it will affect the. Again, it will tell us more about the internal controls, and then we'll be able to have final risk assessment of controls. Let's freeze guys. The second phase is response to risk. This is where we perform audit procedures. We first to explain that after finding out the risk, this is the response. For financial statement level risk, overall response. For assertion level risk, we go for further audit procedure, that is test of control, substantive audit procedure. Then you explain, while planning, we aim at USA. While planning, and third, you explain that after test of control, we again analyze whether our control risk assessment was appropriate or not. Then we perform substantive audit procedure. We again analyze whether our risk assessment was appropriate or not. And then we make a final risk assessment about the final control risk assessment. Okay. Now, last thing is reporting. Pretty simple, straightforward. So after collecting a lot of evidence, first of all, we think whether the evidence is sufficient and appropriate. Is it good enough for drawing the conclusions? Drawing conclusions with reasonable level of assurance. First we think about the evidence, whether evidence is sufficient, appropriate. Is it enough to draw conclusion with reasonable assurance? Is it enough to keep audit risk low? Okay. Then if we think we have enough, so we analyze the evidence. After studying and analyzing the evidence, we think once whether we should change risk level of certain areas and perform more audit procedures. If that's the case, make the changes and perform more audit procedures. So after obtaining evidence, guys, we are supposed to think whether risk levels should be changed and more audit procedures should be there. Okay. Then if yes, do that. After doing that, whatever is your conclusion, whatever your audit findings, whatever you plan to put, go and discuss with TCWG that this is what we plan to write. And after taking their input, finalize the audit report, make the audit report, form your opinion and put it in your audit report. So it's very simple. Reporting. In reporting, first we collect the evidence, whether evidence is appropriate. We sit down and think carefully whether risk needs to be changed, whether additional procedure need to perform. If required, we do it. Then we finally communicate what are the findings, and then we finalize our opinion and put it in a report. So guys, it's a very famous question. It's a very famous question. Risk-based audit, 3 phases of risk-based audit. And I've beautifully explained the 3 phases, and I have given you shortcut for the first phase. It's in a complete flow. About the identify and assessing risk assessment. Then response to risk is nothing but performing audit procedures, and then finally reporting. Come on, guys. Now, steps for identification of risk. Sir, what is this now? What is this? We are going crazy. What is this steps for risk identification? Step for risk identification. Guys, it is in SM23 also. It is in SM23 also. Okay, I will tell you, I will give you a shortcut for this. Don't worry. I will give you a shortcut for this. I will give you a wonderful software. No, I will give you a wonderful shortcut for this. So they are talking about steps of, sir. Now, what is the steps of risk identification? Steps for risk identification. What is steps for risk identification? Guys, this is nothing but what we do in identifying and assessing risk. Let me give you MRI.100, the shortcut. So guys, beautiful. These are big questions. Beautiful. They are big questions. We are understanding what they're asking, what to write, what they're asking, what to write, what they're asking, what to write. I understand it will be difficult for you to remember everything at one go. But if you do it again, you will feel comfortable about it. You will feel comfortable. You will enjoy it, and that's why. That is how we plan. We plan to keep these sessions. Okay. So steps for risk identification. So we simply need to explain steps for risk identification. See, in this particular chart, this particular MRI, this particular part, some things are coming from SA 315 and some things are coming from traditional theory. Okay, traditional theory. So this risk-based audit is a traditional theory. This steps for risk identification is a traditional theory. What to do in identifying and assessing risk? Use supercars. Steps to do in identifying and assessing risk. Sir, you just discussed the first question for the day. You discussed about the identifying and assessing risk. Yeah, identifying and assessing risk, that was a different question, guys. Identifying and assessing risk, we do 4 steps. Okay, that was as per 315 exactly. Now this is traditional theory. So if they ask this, steps for risk identification, so steps for risk identification, get a supercar. So what we do, steps for risk identification, it's very simple, guys. It is very simple. It is on the same lines. It is on the same lines. So supercar, S stand for, in steps for risk identification, we always have to think what is the significance of the assessed risk. What is the significance of the assessed risk? That simply means what is the likelihood? What is the likelihood? What is the likelihood of occurrence? What is the probability that wrong things will happen, misstatements will happen, and what is going to be the magnitude impact? So it is on the same lines. Of course, it is on the same. One thing is as per SA 315 and one thing is traditional. That's it. So S stand for, in fact, if someone says that, sir, if I write, we just discuss identify and assessing risk, only those steps, you may write it. But if you want a very specific answer, this is what we are supposed to write. So first, in steps for identify and assessing risk, supercar S stand for significance. Sit down and think about it. What is the significance of the risk? What is the likelihood that misstatements will happen, and what is the impact? What is the magnitude of misstatement will happen? We have to sit and think about it carefully. Then we always have to think about internal controls. We always have to ask management, okay, this is the risk. Are you having any internal control to mitigate, to compensate this risk? We compensate this risk, and if there are, we need to understand how it is designed, what are the steps, is it effective, and is it properly designed? Can it really detect correct misstatements? Can it really do it? Okay, we need to see the design and its operating effectiveness. How good are controls? So when we talk about steps for risk identification, okay, so we simply need to discuss what we do exactly in risk identification. So we think about the significance of the assessed risk. We think about the controls, supercars. We think about the assertions. We make list. We make list of the we understand exactly which assertion is getting affected. So that will become assertion level risk. Then R stand for risk characteristics. We go and understand the root cause of the risk. We go and understand the root cause of the risk, exactly risk, what is the nature of the risk, why this risk is there. Is it because of complication? Is it because of pressure? Is it because of judgment? Is it because of judgment, or is it because asset can be easily sellable, easy to steal? We understand the risk, we understand the inherent risk, the nature. Is it because of high value inventory, complex, and what is the exact reason? And then, is it a significant risk? If there is a significant risk, there should be special attention. If there is a significant risk, it's a huge risk. Significant risk means very high probability and very high magnitude. Okay, special attention should be there. Special audit procedure should be designed and implemented for significant risk. Okay, let's freeze, guys. So if they ask you what are the steps for risk identification, what are the steps of risk identification? Okay, so you say that you need a supercar. You talk about that we go and look for the significance of audit risk. We go and look for the internal control which can mitigate the risk. We go and look for the assertions which are getting impacted. Is it assertion level risk? We go and look at the risk characteristic, basic reason why the risk arise. We go and look at the, if it is significant risk, there should be significant risk, there should be special attention. And this is very close to four things we have discussed in identify and assessing risk. Okay, let's freeze, guys. So there are two similar concepts. As per SA 315, there is identifying and assessing risk, where four steps are involved. And here, okay, steps of risk identification, it is a traditional theory. A lot of things are similar, but if you remember the shortcut supercars, you will be able to give these things. And if you don't remember, you write, if you exchange it, then only you should get at least 60-70% marks. Don't worry about it. Okay. So yeah, this is the challenge of this particular chapter, that some things are coming from essay and some things are coming from traditional theory. Let's go ahead, guys. So these are beautiful questions. And they're long answers. We are managing those answers. Okay. Revision of control risk. So we just studied risk-based audit, and in risk-based audit, the first phase was risk assessment. Second phase was response to risk, and third phase was reporting. In response to risk, we say that after performing test of controls and after performing substantive audit procedures, now when you know everything, you should make a final control risk assessment. Is it as per the preliminary assessment, or is it different from the preliminary assessment? You're supposed to think about it and make final risk assessment. And as per the final risk assessment, you may have to do more audit procedures. So they have drafted a case. Is conducting statutory audit of Division Office of Public Sector Insurance Company. It has surveyors in the claim under property insurance beyond estimated are to be appointed by Divisional Claim Committee. Going through surveyors appointment details of 10 such claims during the year, 5 instances have come to office where delegation of power has not been followed and appointments were made by divisional manager in place of DCC. So there is a chartered accountant who is doing audit of divisional office, okay, or divisional office of a public sector insurance. There's a delegation of power laid down by company's head office. It is noted as surveyor in claims under property insurance beyond 30 lakhs. Beyond 30 lakhs are to be appointed by divisional claim committee. However, so if the claim amount is beyond 30 lakhs, surveyor should be appointed by DCC. However, on going through surveyor appointment details of 10 such claims, 5 instances have come to his notice where above delegation has not been followed and appointments were made by divisional manager in place of DCC. In the beginning, the auditor has assessed risk of material to be low. The risk of material misstatement to be low. Describe why above findings would change auditor's assessment in relation to above. So guys, it's called application of knowledge now. Let's understand. So basically, they are saying in the insurance company there was a very simple internal control system. If the claim amount is going above 30 lakhs, then the surveyor's appointment should be done by DCC. It should be done by committee. Now, auditors thought that, okay, my preliminary assessment says that control risk is low. My preliminary assessment says that control risk is low. Control risk is on lower side. Okay, control risk is on lower side, and then we start the audit procedures. But then as we test the controls, we came to know that this is not happening. Instead of committee, manager is doing the appointments. That means there is a deviation in internal control system. There is breach of controls. Controls are not being followed. This is a situation. Now, what will happen because of this situation? Okay, guys. So you need to understand. You can explain. You have to explain. See, first we have given answer as per. First we have given answer as per module. It is pretty small. And then we have given, but then I think we simply need to focus on the fourth point. So we may not explain these things. Only this thing need to be explained. Okay. So as per me, how you can draft the answer? It's very simple. You first explain that there's a concept of risk-based audit. Then you explain there are 3 phases, 3 steps, 3 phases. Then you explain there's a second phase, that is response to risk, in which we perform audit procedures. In that, once we perform audit procedures, we get better understanding whether internal controls are operating effectively. And then we should think carefully, is it as per our preliminary assessment, or is it different? If it is different, then we'll have to change the control risk, and we may have to change the audit procedures. So once we perform test of controls, we get deviations. After analyzing deviation, we understand whether controls are operating effectively or not. So, and we understand whether the preliminary assessment of control risk should be continued or it should be changed. Okay, so you should do, if change is required, you should do that and change substantive audit procedure accordingly. After performing substantive audit procedures, our understanding will further change. With respect to internal controls. And then we'll be making final assessment of control risk. Final control risk assessment. Okay. So explain this simple concept, and then you discuss the case. In this, you discuss the case. We started with low RMM. We thought controls are good, control risk is low, RMM is low. We started with that, but suddenly we realized there are a lot of deviation. Our preliminary assessment was not appropriate. We have to increase that risk and perform more substantive audit procedures. And after performing substantive audit procedures, our assessment may change again. So you need to explain this. So here the conclusion is very simple. We need to revise risk of material misstatement. That is the conclusion. Guys, the way they have drafted a new study material, that's why new study material is extremely important. So that there was one single paragraph in the module. There was one simple paragraph in the module, and they drafted a case out of it. That's why SM questions are important. That's why Q&A practice is extremely important. Okay, guys, lovely. We have discussed lovely different types of questions. Come. Now let's see. This is a very famous question, because it has been there since long. May 9 exams, May 12 MTP, RTP exams, and then it's in the new study material. November 23 mock also it was there. So, as the auditor, what would you like to limit your examination of account? What would like to limit your examination of account balance test? What are the control objectives? You would like the accounting control system to achieve to suit your purpose? So, sir, what is the question all about? So, question is saying that we would like to reduce our audit procedures when we go and check accounts, when we go and check account balances, when we go and check transaction balances and disclosure. So they are saying that they would like to reduce their substantive audit procedures. If they want to reduce their substantive audit procedures, they will have to first check the internal controls. Internal controls should operate effectively. If the internal controls are operating effectively, if they're achieving their objectives properly, then substantive audit procedure will reduce. Let's freeze, guys. They're simply asking, they are simply asking that how can you reduce your audit procedures? You reduce your audit procedures if you go and check the internal control systems, if the controls are operating effectively, if the controls are achieving their objectives properly, we will reduce our substantive audit procedures. Now, they are asking, so a good internal control should achieve what objectives? Good accounting control should achieve what objectives? If you see, guys, first few things are nothing but assertions. Now, this is where I come into picture. This will make things easy to remember. This will make things easy to remember. Easy to remember. Let's see, guys. Now you must be aware the assertion about transactions. Suppose we have sales of 1,000 crore. Suppose we have sales of 1,000 crore. Sales of 1,000 crore. Okay. So directly, indirectly, it is saying that it is real. Occurrence. Occurrence is the assertion. Okay. Then occurrence is the assertion. Then it will say that nothing is left out. Everything is covered. Completeness is the assertion. Completeness is the assertion. Then amount is appropriate, amount is proper, accuracy is the assertion. Then classification, within organization, proper business within business, proper division within division, proper account is used for accounting, proper classification, and finally cut off. Transaction of current year doesn't go to next year, and next year does come to current year. So first few things are exactly for the assertion. So you need to write, we need to check whether controls are achieving its objectives properly. So number one, say occurrence. System should ensure that only real transaction should get recorded. Only real transaction should get recorded. That means occurrence. Okay. Then completeness. Ensure that all the transaction, whatever transaction happened, should get recorded. Nothing should be left out. Then accuracy. It should be recorded at proper amount, properly valued, proper amount recognition should take place. Accuracy. Then it should ensure that transactions. Then it should ensure that transactions should be properly classified. Transactions. Okay. Transaction should be properly classified in proper accounts head. Ensure that it record in timely manner. Transaction of current year doesn't go to next year and doesn't come to current year. Guys, this is going to make it very simple. So these are the objectives which internal control should achieve. Basically, it should ensure that assertions are protected. And then next, bookkeeping process. It should ensure that all the transactions are posted after recording. They are properly posted to secondary books. After posting, they are properly balanced, summarized, they should properly presented in financial statement. Proper disclosures are there in notes to accounts. So it is a bookkeeping process. So let's freeze, guys. This question has been asked again. Let's freeze. See, doesn't make sense to make mnemonic everywhere. Okay. Doesn't make sense. It doesn't make sense, guys, to make mnemonic for everything. So here the question was very simple, pretty simple. What things a control should achieve? What are the control objectives? It should achieve protection of assertions. So 5 points will get covered. It should ensure proper bookkeeping. 3 points will get covered. It's very famous thing. Okay. Now. Flow chart technique, guys. Flow chart technique. See, guys, these questions are from the new study material. I know that these are very old traditional theory. This is not sophisticated theory of standards on auditing. But because it is in study material, it becomes important. Come on, 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 guys. Come on, come on. I understand a lot of questions, a lot of lovely questions are there, a lot of answers are there. But then try to understand the crux. Try to understand the crux, what question wants to ask. Try to understand the crux, what question wants to ask. Try to understand the crux, what answer wants to say. Try to feel that thing. That's very important. And then you can revise it and become better and better in it. Better and better in it. Okay. So we are supposed to write a short note. We are supposed to write a short note on flowchart. What we are supposed to explain briefly the flowchart technique for evaluation of internal control system. So talk about the flowchart technique. Talk about the flowchart technique. Okay. So okay, quickly. So what we'll first quickly define what is flowchart. Graphical presentation of the internal control system. A graphical presentation of the internal, each part of the internal control system. That is each part of the internal control system. That's called flowchart. It is very good. Flowchart gives it gives bird's eye view. It gives the overview of the system. It gives overview of the system. Okay. Yeah, it's very concise. It's very concise. It's very small. It gives overview. Less narrative explanation is required. Better understanding of the system. So first focus on definition. Then you focus and explain some advantages. It's very simple. It's concise. That's really good. It gives bird's eye view and good understanding. That's really very good. It's easy to understand and find out the deficiency. It's very good. Now, a properly drawn flowchart, a properly drawn flowchart can provide a neat visual picture of the whole activities of the section of department. More specifically, it can show. Okay. More specifically, a good flowchart is going to tell you these things. So shortcut is Vishal reads. So Vishal sir, it got connected. Okay. Vishal reads visual clarity. So it is again, it's a kind of benefits only, advantage only. If a good flowchart is created, it will give a visual clarity. It will give absolute visual clarity. What is the flow of transactions? Where it starts, how it progresses, how it concludes. A complete clarity, visual clarity will be there. Then it is going to help in record management. It clearly explains. It clearly explains where document. It clearly explains. Now, guys, record management. Record management. Uh, it clearly explains, illustrate the filing of the documents at their filing of the document, their final disposal, whether by sending out or destruction. Okay, so it clearly explains how documents are created, where they are stored, or how they are disposed of or sent. So it gives the flow of the record. If it helps in record management. You know exactly in which department or which person or which files, which documents will be there. Expertise requirement. A person should be very knowledgeable, experienced and skillful to understand the system and to draw a flowchart out of that. A sound understanding of internal controls, good visualization, analytical mind is required. Reads authorization distribution. It beautifully explains how documents are authorized, and then how they are distributed within the company, within the entity, how it flows from one person to another. Document tracking. It can depict the point at which document is created internally or received from external sources, number of copies made, and the sequential stages through which the document and activity passes. So we know where records are kept. We also, so earlier point was focusing on we understand where records are kept. Here they want to say we understand the complete flow of the document. And section wise, generally it is prepared section wise. Sir, what do you mean by section wise? Now see, these are the sections. Like when we talk about sales, order receiving will be one section. After order receiving, how dispatches happen, there will be another section. How billing happens, that this everything is from the module. Everything is from module. How orders receiving function. How dispatch happens, dispatch function. You don't have to write it. It's simply example. How billing happens, then how accounting happens, and then how inventory records are updated. So these accounting, general ledger, and then inventory. So these are different sections of the flowchart. Sir, how much we have to write? Let me explain, guys. Drawing a flowchart. So you should be aware about all the different types of symbols which is used, what its general meaning, and you can use symbols. There are symbols for start of the activity, for authorization, for documents. So proper symbol should be used for proper understanding. Linking function. It should carefully link. Functions such as purchase are linked with trade payable, payments, and sales are trade receivable, collection. Flowchart should clearly link things which are connected with each other, like sales, debtors, and collection. They are connected to each other. It should link properly. Chart, or it is typically horizontal. It can be asked in MCQs. Typically horizontal. Okay. Transaction flow. It should be in a sequence of how transaction progresses. The first section should represent how the transaction starts, originates, authorized, and how it progresses and how it concludes finally. Questionnaire integration. Sir, what is that? In flowchart, wherever you get placed, you can simply explain what kind of question it solves. So if anyone wants to understand what this flowchart is going to explain, it should explain that, okay, this is going to explain flow of sales. It is going to explain flow of sales. It is going to explain these and these stages of the sales. It is going to explain dispatches. It is going to explain record management. It is going to explain documentation flow and so on. So question integration should be there. Let's freeze, guys. So final. If you get a question in exam about flowchart, first you'll explain the definition. It's a graphical presentation. You'll give a small advantages, a lot of benefits flow. It is concise, bird's eye view, less explanation, more understanding, easy to find out deficiency. Then you'll explain, okay, that then you explain that if you, for a good flowchart, what are the points connected with a good flowchart? Okay, Vishal reads is the shortcut. V stand for visual clarity. A good flowcharts will give a lot of visual clarity. Again, you can say that these are the things you get from flowchart. It gives you visual clarity. It tell you where records are stored, where they are kept, how records are managed. It is going to tell you, but to make this, expertise will be required. It will tell you how authorization happens, how distribution of document take place, how document tracking can be there. It is section wise. So a good flowchart is going to give you this information. And for drawing a flowchart, you need a slot for question. Slot. You need to understand symbol representations. You need to link things. You need to have proper orientation. You need to have proper transaction flow. You need to have questionnaire. Let's freeze, guys. Even if you write 50% things out of it, even if you write 50% things out of it, it is absolutely fine. See, guys, my job is you would have spent half an hour, 45 minutes in it. You would have got frustrated. But then I'm helping you out that you don't get frustrated. Okay, follow this shortcut, follow this flow. Try to remember 50-60% things. Put it. So whatever you are going to say, talk about definition, about the advantages. A good flowchart. Okay. As Vishal reads, gives you a lot of things. A good flowchart, as Vishal reads, gives you a lot of things. And if you want to make a good flowchart, okay, there's a shortcut. You need a slot with questionnaire. You will slot with question. You will be able to make good flowchart. Okay. Even if you write 50-60% thing, it is absolutely fine. Okay, guys, come on. Next. So that was quite a traditional. This is quite a traditional theory, guys. This is quite a traditional theory, but you cannot leave this today. One more traditional theory, guys. One more traditional theory. Internal check. Study material 23. May 22 mock. They are talking about internal check. It is again a traditional thing. Okay. So they will ask you about the internal check. Now see, it is in the study material. A new life hospital, a multi-special hospital has been facing a lot of pilferage. Pilferage means things are getting stolen in small quantity. So in hospital, a lot of stealing is happening. Pilferage is happening, and troubles regarding inventory maintenance and record control. On investigation to matter, it was found that person in charge of the inventory inflow outflow from the store is also responsible for purchase of maintained record. So person who is managing the inventory, same person is managing the record. It is clearly a blunder. It is clearly a blunder. Person who is managing the asset should not manage the records. Managing the asset, you should not manage the records. According to you, which basic system of control, basic system, this is a error in module also, basic system of control have been violated. Basic violated. Also advise other general conditions pertaining to such system which need to be maintained and checked by the management. Honestly guys, if someone has not done the Q&A practice, someone will answer this question. Someone will answer this question from the it can be answered from different point of view, but then you should know that okay, this is, they're talking about internal check. What is internal check? What is internal check? When work of one person, if one person is automatically checked by someone else, when work of one person is automatically checked by someone else, then that's called internal check system. Internal check system is a very important requirement of any good internal control system. Any good internal control system. So we are supposed to write about internal check system, but then the person who has done this practice, that person will be only able to understand it that okay, this is a question which is connected with the internal check and I am supposed to write about the internal check. Okay, so on the same lines, again the last question is also in the same lines. They are explaining what is wrong. The question again, they're explaining what is wrong with these systems. Same person is handling ledger also and cash receipts also. Same person is managing dispatch also and delivery challans also. But then they are giving the hint also. So on the same lines, they are focusing on this. Same person is doing two non-compatible things. Same person managing the assets, receipts, payments and doing accounting also is not a good idea. Let's go to MRI.480. So guys, whatever questions we are discussing, they are bulky questions. Whatever questions we are discussing, they are bulky questions, big questions. Okay. So these are bulky questions. These are bulky questions, guys. These are bulky questions, and we have made some shortcuts, some flows. If you go through that again, you will feel comfortable. So, okay. Prashant says, I will watch this series at least 5 times before going to exam. I think you will get comfortable as you watch them again. Now, so when you talk about internal check system, there are a lot of things you talk about. Sir, how much we should explain? Okay. We have summarized it. Let's see quickly. First, we explain the overall system. It's again a traditional theory. So as per traditional theory, in overall system, first we have administrative controls. Managing the employees in the organization, in the department, all the rules, regulation connected to the employees, their regular attendance, their regular productivity, their compensation, their overtime, their bonuses, everything that is administrative control. Everything connected to employees administrative control. Then how things are recorded in books of accounts, how vouchers are prepared, how primary books, secondary books, how trial balance, consolidation, financial stream, they are accounting control. Overall, then internal check is a part of the system where work of one person is automatically checked by another person or another system. That's called internal check. That is a maker checker concept. Internal check is nothing but maker checker concept. And internal audit is a function which checks whether all other functions are working properly and how to improve upon them. So when we talk about overall system, first comes administrative controls, then come accounting controls. In them we have internal check, and for all of them we have for monitoring of all of them we have internal audit. organized in such a manner that a single person is not responsible for the work. There are multiple people involved, and work of one person is automatically checked by another person. That's called internal check system. Independently, this is the independently verified by another person or another system. It's called internal check. So first you are going to explain the definition, and then you are saying, so why this is thing. This is drastically going to prevent material misstatements. That's going to detect and correct material misstatements. It's going to make people efficient, because everyone doing the small thing, it is going to make people efficient. It is going to make people responsible. Everyone knows who is responsible for what work. It's very simple. Objective, you can talk about objective, you can talk about advantage. It prevents material misstatements, it detects and corrects material misstatement, it makes people efficient. It is very easy to point out who is responsible for what thing. So you explain overall system, you explain what is internal check system, you explain the overall objective and the advantage and how it is implemented. That's interesting. First few points are into system designing. Shortcut: independent, military and NDA. Okay, independent. So how you implement internal check system? Independent accounting control. Always ensure that all the transactions which are happening in the company, there's an independent account department which overviews and checks the transaction. Having independent accounting control, independent accounting department, having overviewing and checking the transaction is a very good internal check system. Accounts department will check transaction of all other departments. Okay, independent military. So that's good. Independent military and NDA. Military and NDA should be different, so that work of one is automatically checked by another. Then M stand for mechanical devices. There should be mechanical devices. For example, for cash counting, there should be mechanical devices. Mechanical devices for attendance, there should be mechanical devices. So work of one person is checked by another person automatically. NDA, no single person should be responsible for a particular transaction, for a control. There should be segregation of duty. Automatically maker checker concept will happen. DA, distribution of power with periodic review. Power should be distributed and delegated to people, and it should be periodically reviewed. So again, there will be maker checker concept. The people who are executing is different and people who are supervising is different. And the most important, asset custody and book maintenance. The person who is maintaining asset should not be the person who is maintaining books of accounts. Okay, so how we implement internal check system? We have independent military and NDA. So independent accounting control is good, mechanical devices is good, no single person is good, distribution of power and review is good, asset custody is good. Start of the year, then there are more things. Start of the year, make budgets, then keep comparing budgets and actual. That's a good internal check system. During the year, keep rotating, job rotation should be there, so that when job is rotated, automatically whoever person gets the job. See, in bank, job rotation keeps happening, transfers keep happening. So when you go for job rotation, automatically new person is going to check whether the old person did the work properly. Compulsory, send people on leave during the year. Go for job rotation, send people on leave. When people go on leave, their work is done by someone else, automatically their work is checked. Periodic review of accounting records, automatically things will get checked. End of the year, go for stock taking. When you go for stock taking, match the stock and actual stock and actual stock and the stock in the records, automatically you will understand whether records are kept properly or not. Okay, so guys, let's freeze. So if they talk about internal check, you explain the overall system. Internal check is part of it. Define in 1-2 lines what is internal check system, give advantage, objectives, and then explain how it is implemented. First few points are explained with the help of a mnemonic. Then beginning of the year, there is one system. During the year, there are more ways. End of the year, there are more ways. See guys, this was huge. Okay, but then our techniques are going to make it pretty simple and easy comparatively. Otherwise, it's a one and a half page thing. Okay, now this is a very useless question. This is inter-based question. So There is an entertainment center. There is an entertainment center. There is an entertainment center, so there can be This can be a water park. There can be amusement park or something like that. Okay, it's spread across 250 kilometers. Uh, you talk about internal control system towards collection of money. What kind of internal control system? So guys, we have made this diagram. This diagram will be very, very important for remembering. Okay, so they are saying that there's a big amusement park, and we need very good internal control system for collection. So we are supposed to focus on 5 things. Number 1, printing of tickets. Ticket should be print. The ticket, you talk about it. Ticket should be printed. It should be in a standard format. It should be pre-numbered. It should have all the details. Different tickets can be printed for different category, for different days, and so on. So printing tickets is a very important internal control system, and printing in booklet form, bunch form is a very important internal control system. Then next is there should be a different document for advance booking. There should be internal control to ensure that proper money is collected for advance booking and proper issue of tickets happens after the advance booking. There should be strong internal control system for the ticket sale. There should be proper internal control system how tickets are sold. For example, after every 2 hours a reconciliation should take place. This were number of tickets sold, these are the remaining tickets, and and the total matches with the booklet, and this is the collection. There should be proper internal control system for advance booking, after that ticket sale, and if the discount or free passes are issued. Then you talk about there should be regular reconciliation. Maybe after every show or end of the day, there should be reconciliation. This was money collected after for each show. You should see the accounting into cash entry for the each show or for the each day, and you should ensure that whatever cash was collected in a day, next day it is properly deposited in the bank. Then you talk about entrance. At the time of entrance, ticket should be marked or marked in such a way that it should not be able to be reused. It should not be reused by someone else. There should be surprise checks. Surprise checks for cash count to ensure everything is done properly or not. Let's freeze, guys. They're talking about the entertainment center, 250 kilometers, 250 acres, 250 kilometers, the peripheral. So what kind of internal control system should be there for collection? So this diagram should be there. There should be strong you will talk about printing of tickets. You will talk about advance booking, ticket sale, and the free tickets. You will talk about the cash reconciliations and cash deposit. You will talk about the entrance. You will talk about the surprise check. So you will need internal control system for these things. Again, it's a traditional question, guys. Again, it's a traditional question. I am taking this only because it is in the new study material. Anything which is in the new study material becomes extremely, extremely important. We cannot afford to leave it in any manner. Finally, guys, we are through with a very, very big part. We are through with very, very big part, guys. Okay, very, very big part. Okay, let's see, guys. Let's see. Now we come to essay 265. Now these things will be focused more on the standards on auditing. Okay, let's see, guys. Now, so during the course of audit, notice material weaknesses. There are material weaknesses in the internal control system, and you are supposed to draft a letter of weakness. Okay, let's understand. Okay, so it's pretty simple. It is pretty simple. We are supposed to focus on 3 things. Okay, number 1. In the course of audit, we keep on understanding internal control system, we keep on testing internal control system, and we may come across a situation, circumstances that there is a deficiency in the internal control system. Okay, deficiency in the internal control system. So if there's a deficiency in internal control system, now so I'm explaining the background, now you're writing. Now you write that. If we come across a deficiency in internal control system, in writing we are supposed to communicate this. In writing we are supposed to communicate this. What are we supposed to explain in writing? So now this letter is called letter of weakness. This letter is called letter of weakness. This letter is also called management letter. This letter is also called management letter. It is also called communication for internal control deficiencies. A communication for internal control deficiency. The first thing you explain what you explain main content of the letter. So if auditor comes across internal control deficiency, he will be explaining, he will be drafting letter. In writing, he'll be explaining two things. Description. Description of the deficiency. There's a description where there's a problem with the purchase or production or sale or recovery or accounting and what exactly is the problem. Then we'll be explaining what transaction balance and disclosure is getting exposed because of this deficiency, where the impact can be. Then we're going to be sufficient information. What is the amount of transaction balance and disclosure? We'll also explain the probability. We will explain what kind of impact can happen because of this deficiency. If purchase is getting affected, purchase is 1000 crores and there's a 20% chance that it will get affected, 200 crores can be the exposed amount where things can go wrong. Okay, so we'll explain clearly. This is the description. This is the TBD getting affected. This is the values. This is the probability. This can be the potential impact. Then second, very important, we are giving some clarifications and caution. Caution. We say that, listen guys, our work was to give, our basic purpose of the audit was to give opinion on financial statement as per applicable framework, and it's a fair presentation framework. They give true and fair. We perform this audit as per standards on auditing. So we understand controls and we test controls so that we can have better planning of our audit procedures. We never had objective to report on internal controls and their deficiencies. We'd like to explain that. Our basic objective was audit. We did it as per essays. We went for understanding. We went for testing, and but to have better audit procedures. Our objective was never ever to comment on internal control systems. So please don't misinterpret our letter. These are limited deficiency which we got during our audit process, audit of financial statements. This is not the complete list. There can be more deficiencies. This is not the complete list. There are more deficiencies. Don't consider this as a certification of the internal control system. Don't use this letter anywhere else. It is just only for your information. So we are going to explain limitation of our communication. That's going to be very important. And third is usefulness. Control system. Auditor can always say that I have communicated everything. To the management. If something goes wrong to Mather, they are responsible. I am not responsible for that. So you explain three things: the main content, the clarifications and the caution, and the clarifications and the limitations. Caution, instead of caution, you can have limitations, and then the usefulness. Okay, guys. Come on. Okay, now again, very interesting. So what should be the communication? Now this question has been there in May 22 mock, May 23 RTP. It is dying to come in exams. Now deficiency can be of two types, guys. Deficiency can be of two types. It can be significant deficiency or it can be other deficiency. When deficiency becomes so big that is very important for us to go and communicate to TCWG, that's called significant deficiency. That's a broad meaning. What is the specific meaning? Of significant deficiency? If a misstatement has been detected because of that deficiency, it is significant. Or there's a very high likelihood that a misstatement can occur. Again, it is a significant deficiency. Okay, so significant deficiency, the broad meaning is something so big that needs to be communicated to TCWG. A specific meaning is misstatement has already occurred, or there's a big likelihood that misstatement will occur. Now, how to find out whether deficiency is a significant deficiency or a other deficiency? There are certain factors which you need to consider. Certain factors which you need to consider, guys. Okay. So, internal control constitutes significant deficiency. He is to determine, guide CA what matters. So the first two questions are straightforward. What matters to need to be considered to decide whether the deficiency is a significant deficiency or other deficiency. Then there's a big question out there. And Shreyan's manager is an audit team identified that there is a significant risk in lease transaction. There's a lease transaction, there's a significant risk in lease transaction, there's a lot of risk in after Shreyan's so what Shreyan's identified that they are entering into lease transactions and it's a cross-border transaction. It's a cross-border transaction and a lot of misstatements can happen there. Lots of misstatements can happen there. Big misstatements can happen there. There's a significant reason lease transaction. And then later on realized that management is having its own risk assessment system. Management is having its own risk assessment system and management system didn't identify this significant risk. So they want to say that management is having weak risk assessment system. This risk assessment system is ineffective. It is not operating properly. Okay. And Shreyans feels that having a weak risk assessment system in itself is a significant risk. But engagement partner has different view. Engagement partner is a different view. Engagement says that no, your approach is not correct. Only when a huge magnitude of misstatement can happen, only they can go. So basically manager is saying if these guys are having weak risk management system, it is a significant deficiency. But partner is saying no. There should be actual misstatement or a potential misstatement, then only it will become a significant deficiency. So guys, it becomes, if they ask question like this, they are applying the things. It's very important to go through the questions. It is very important, damn important to go through questions. Guys. Only the student who has gone through these questions will be able to interpret it. So what was the answer? Answer is pretty simple. They are first talking about the definition. Okay. So it is a broad meaning. So deficiency, if deficiency such big that it should be communicated to those charged with governance, is a significant deficiency. Then a specific meaning. If a material misstatement has occurred because of the deficiency, it is definitely significant deficiency. But even if the material misstatement has not occurred, but there is a very big likelihood, that material misstatement can happen. That material misstatement can happen because of this. Okay, material misstatement can happen because of this. A big magnitude misstatement can happen. Then also it can become a significant deficiency. There is a broad meaning. There is a specific meaning. Now they are explaining the matters. You need to. So the shortcut is very amazing flaws Smith style. So you can say that significant deficiencies have very amazing flaws. Okay, let's take an example. There's a company which imports coal of 800 crores, which buys coal of 800 crores in a year. And at the same time, they buy wood of 50 crores in a year. and now there's a deficiency in both, in coal and wood. We need to decide which is a significant deficiency and which is a other deficiency. So first thing is volume of activity. First thing is volume of activity. Volume of activity. So coal you purchase 2-3 times in a week. Volume of activity is very high. If the volume of activity is very high and there's a deficiency, there's a good chance it will become significant. Then amount exposed. 800 crores is getting exposed. Very good chance that it will become a significant deficiency. Frequency of exceptions detected and its causes. In past, lot of mismatches has happened, and many of them has been intentional frauds, etc. is involved. If lot of mismatches, lot of issues has happened in the past, big chances it will be that area will be having significant deficiency. Likelihood is very high. Good chance that it will become significant. In the same area there are more deficiencies, so lot of deficiencies are coming together. Management is not good in authorizing, the machine for quality check is not proper, GR is not prepared properly, there are multiple deficiencies in that area, big chance it will become significant. Susceptibility, basic nature of the item is susceptible to loss. Coal is susceptible to losses. Lot of moisture content will be there, it can be manipulated very easily, it is very difficult to count and measure the coal. If subjectivity and complexity is involved, lot of personal opinion, subjectivity and complexity involved, big chances that it is a significant deficiency. Very amazing flaws, huge volume of activity, amount exposed is very high, frequency of exception is very high, likelihood of deficiency, other deficiency, susceptibility, subjectivity. So these are the factors, guys. These are the factors which will help us know whether deficiency is a significant deficiency, whether it is a significant deficiency or whether it is a other deficiency. But this is not the end, guys. There are more things out here. There are more things. POMs. If very important controls are missing, okay, control over prevention detection of fraud, controls for prevention detection of fraud are missing, okay, such a big important control is missing, it's a significant deficiency. There is no proper control for outside normal course of business. For the unusual, there are no proper controls to manage outside normal course of business. There is no clarity at all. Significant deficiency. There is no monitoring of controls. Significant deficiency. There is no control for period end financial reporting. Significant deficiency. There is no proper control for significant accounting policy. Again, it is a significant deficiency. Okay, guys. So in this, you need to explain first broad meaning of significant deficiency, specific meaning of significant deficiency, matters. These matters should be seen. Very amazing flaws style should be seen to find out whether deficiency is significant or other. Then POMs. POMs is important. You need to see that if controls are missing for such important thing, it is a significant deficiency. Okay. Now, guys, here in the question we are discussing that internal there is management system is missing altogether, risk management system is missing altogether, or it is not effective. It in itself is a significant deficiency. Very big control is missing, is not operating properly, in itself is a significant deficiency. We'll go with Shreyans that it is a significant deficiency. systems are not able to identify significant risk in itself is a significant deficiency, guys. See guys, this is not just 315, this is extra thing. 315 is covered extensively in part 1 MRI. It is extensively covered. Major concepts. Quickly, we talk about there are two concepts in 320 we're supposed to focus on, and there's a very interesting concept we are focusing on two questions of 330 also. Let's quickly finish it off, guys. Let's quickly finish it off. Okay. Benchmark. Okay. So we already know how materiality is computed. It's very simple. We take a benchmark. Benchmark can be profit based. Profit based benchmark is there, can be there, or it can be based on revenue. It can be based on profits bigger than that. Generally, it can be based on total assets. Asset based benchmark can be there, or it can be based on revenue based, total revenue, sales based benchmark. Then we apply a percentage. So very famous is profit before tax into 5% is a very famous way of computing materiality. Or say 1% of the total assets is a very again famous way. 0.5% of the total revenue, and so on. So this is how we compute materiality. That's called benchmarking process. And then that is benchmarking process. Now, how we select the benchmark? How we select the benchmark is a very, very famous question, has been asked again and again. 320.020. We have been discussing, this is a very famous question. Let's see. Step number 1, benchmarking process is a 3-step process. We decide the benchmark, we adjust the we decide the benchmark, we adjust the benchmark, and then we apply the percentage. We get the materiality. So we have a shortcut, items in oven. A very simple shortcut, items in oven. I stand for items of financial statement. It's very simple. We need to understand on which item users of financial statements are focusing. If they're focusing on a particular item a lot, then for that particular item we can have a different materiality altogether. Okay, so different materiality altogether. It's very important. We need to understand what users are focusing on, and as per that we need to select the benchmark. There's the first point. Next is ownership structure. Items in ownership structure and finance structure. If in ownership we have big shareholders, they may focus on the earnings, they may focus on the total profits, how much profit, because they can control the total profits. That may become the benchmark. If it is a scattered ownership, a lot of small shareholders are there, then they may focus on what is the profit available for dividend. That may become the benchmark. If the equity financing is more, then earning based benchmark will come. If debt financing is more, then net asset may benchmark may come. So depending on who are the owners and which financing is more. Their preferences will be considered. So the basic principle is we need to understand what users are focusing on what items they are focusing on, and then there's a guidance. We need to understand who are the owners and what are they focusing on, what is the financial structures and what are the financiers focusing on. Then V stand for volatility. Whatever you decide, it should not be very volatile. Whatever you decide, it should not be very volatile. Because if it's very volatile, maturity level will keep changing very fast, and that's not good. And that's not good. Okay. So it should not be volatile. If you feel that net profits are very volatile, go for gross profits. If you feel gross profits are very volatile, you go for total revenue. It should be one of the element of financial statement. It should be either profit, either total assets or total revenue. It should be one of the element of financial statement. Nature of the most important nature of the entity. If it's profit oriented, you go for profit. If it is NPO, if it is government, you go for turnover. If it is a NPO, non-profit organization, you go for total asset or total capital. Economic environment. If it is a booming economy, you go for profits. If it is a recession, you go for cash flow statement. Depends on industry. In pharma, they may focus more on R&D expenses. Depend on life cycle. Initially, they focus on sales, then they focus on profits, and so on. So it depends on nature of entity, the economic environment, the industry, and the life cycle of the company. Okay, so it depends on that. So it's pretty simple, guys. It's pretty simple, straightforward. It depends what these guys are focusing on, items of financial statement, then owners, what owners are focusing on, finances are focusing on. It should not be volatile. It should be one of the element. It depends on nature of the entity, its economic environment, industry, and life cycle. So these are the factors. These are the factors you are supposed to talk about. Now there's a very interesting thing. There a very interesting thing. How to compute materiality for air condition, manufacture and sale of air condition having regular profits, and a large infrastructure projects where there are losses for previous 2 financial years. See this question and the next question is on the same lines. It has been asked in examination, so both are on the same lines. See, so for air conditioner, regular profits. So profit before tax can be a good base benchmark for a construction of large infrastructure project where there are a lot of losses. We cannot have loss as a benchmark. So in this case, total cost or net cost can be taken as, so cost can be used or assets can be taken as appropriate benchmark. So that's very important. This has been targeted in November 22 exam. This has been targeted in the November 22 exam. So that was, this question was removed, but then these are on same lines. These are on the same lines, same question. Same as 42.000. No need to have 2 separate questions. Anyways, we have to cover 2 questions, guys. Let's freeze, guys. In benchmark, we have made a shortcut. Items in O1. These are the factors you need to consider before you make a benchmark. And this is a lovely thing. If they are regular profits, go for that. If they are losses, you may go for total costs as a benchmark or assets as a benchmark. A revision of materiality. Very, very simple. Revision of materiality. Revision of materiality. Yes, we understand that materiality is computed at the initial stage of audit, but then if you get new information, it can definitely be revised. It's not a rigid thing. It is not a rigid thing. So first explain, as you get new information, revision is done. Okay, and in the process of revision, if they conclude that we are decreasing the materiality level, that means we have to be very careful. we have to change, revise, we have to change the performance materiality and nature timing extent of further audit procedures. Nature timing extent for further audit procedure need to be changed. So first explain, yes, revision is very much possible. Then you explain the impact, that if the material is going down, we need to be very careful, change performance materiality, increase nature timing extent of further audit procedures, because that area has become very sensitive. And next you give examples. There are 3 examples. So big thing is business. If there's any, if an suppose we're planning to dispose a particular business segment, or we have started a new segment, everyone is going to focus on that. So you may need a lower materiality for that particular business. Any business which has recently started or getting close, people will be paying attention to that. You need to revise materiality for that particular business. Then auditors understanding, then the smaller thing, auditors understanding has changed. Auditors feels that this area is way much risky. This area is much more risky as he was thinking. This area is much more risky as compared to what he was thinking. We need to be more careful. Again, reduce the materiality level for that particular area. Actual financial results are way different from the estimated. Again, the base will change, materiality will change. So big thing, business is changing, or the understanding is changing, or actual results are changing. Okay, so you can have bua. So in Hindi, bua means aunt. Okay, so bua is changing. So if bua is changing, business is changing, understanding is changing, actual results are changing, we revise. So simply explain, yes, it is possible, it is done. Then you explain that if we go on the lower side, we need to be careful, revise performance materiality in NTE, and then you give the examples. Let's quickly see 2 more questions, guys. Then we are through with this chapter. It was having a huge thing with it. So we have covered all of them. Can we rely on previous year test of controls? Very interesting. Very interesting. Can we say that this year I will not test some controls? This year I will not test some controls. I will rely on the previous year controls. May 22 RTP, November 19 mock paper. They have asked this. Can we do that, guys? Can we do that? Only 2 more questions, then we are through. 2 more questions and then we are through, guys. 330.060. Is the concept number it makes things very easy for me to locate it. That's why we go with the concept number. Okay, quickly understand this, guys. Yes, every year auditor need to carefully decide can he use the evidence of the previous year for test of controls. For how many controls he can use evidence of previous year, and for how many controls he should go and test them. Understand that? It's very simple. In the first audit, he has to test all the controls. For subsequent audits, he has to simply sit and decide, okay, that in a particular year, for which controls he can use evidence of the previous year, and for which controls he will have to go and retest the controls. So it's very simple. First, you explain the approach. That auditor need to carefully decide in which audits in a year for which controls use the previous year evidence, and for which controls go for retest. Again, first year you have to check all the controls, no issue with that. But then the subsequent years you have to carefully decide for how many controls you go for previous year and how many controls you go for retest of controls. Then you explain the factors. These are the factors. PM and CM are chief guest. Ask them. If the people have changed, then we P for personnel. Personnel has changed, people have changed, employees have changed. We may think that okay, Let's go for retest of controls. Previous year effectiveness, if previous year controls were not very effective, somehow we relied on them, let's go for retest of controls. If there are manual controls are not very reliable as compared to automated, let's go for retest of controls. Then other components, the other components like control environment are not very good, let's go for retest of controls. M stand for material misstatement. There's a risk of material misstatement. There's a risk of material misstatement. It's a risky area. Again, let's go for retest of controls. Okay. And we are heavily dependent on internal controls. If we are heavily dependent on internal controls, that is our strategy. Why to compromise? Let's go for retest of control. Change in circumstances. Circumstances have changed a lot, but controls have not changed. Now we fear whether controls are appropriate or not. Let's go for retest of control. General IT controls are very weak. Username, password is easily shareable. It is on the screen. It is with the post-it everywhere. It is there. General IT controls are very bad. Let's go for retest of controls. So first we explain what is the approach. In every year you need to decide. Every year you need to decide whether to use the previous year evidence or whether to go for retest of controls. These are the factors. These are the factors he's going to look for. Okay. After seeing all these factors, suppose he says that, okay, for some of the controls, I plan to use previous year evidence, and for some of them, I go for retest of control. Now, if he feels that, okay, he can go for previous year evidences, he should see whether that evidence is still relevant. For that, he should see whether there are significant changes in control. If he says, okay, last year evidence is possible, before he takes the final step, go and see whether that evidence is still relevant, whether significant changes are there. If there are no significant changes, that evidence is still relevant in the current year also. Okay. If yes, if that is yes, if there are change in controls, you will have to again go for retest because it is not relevant. If there is no change, fantastic. No change, he can rely on the previous year evidence. But always keep in mind, test of control should be done at least once in every third audit. That means the gap of testing should not be more than 2 years. In case of any control, you can rely on the previous year for maximum 2 years. Gap should not be more than 2 years. Every third audit, you have to test it. Whatever strategy you decide, every third year, you have to test it. And strategize in such a manner that every year you keep on checking some controls, so that the workload doesn't come on any particular year. Okay. It's very simple. It's very simple. You divide the controls in 3 parts. A, B, C. Okay, first year you are going to check all the control. Next year only check A. Next year only check B. Next year only check C, and so on. If you keep on doing this, it's beautifully, the gap between 2 test of controls will not be more than 2 years. The gap is not going to be more than 2 years, guys. So let's freeze. Let's see, guys. It's very, very simple. And then the final strategy. So 3 things. Yes, every year we need to decide. These are the factors. The final strategy can be, whatever the strategy, the gap should not be more than 2 years. It should be once in every 3 audits, and do something so that you check some controls every year. If you want to do that, it's very simple. Divide controls in 3 parts and check 1 part every year. If you do that, automatically every part will get checked after 2 years and workload will be systematically divided. Okay. Last question, guys. We go for the last question. We'll be through with the chapter. Okay. Now, what is the question? While conducting statutory audit of the Hope Solutions, CAY has assessed the risk of material misstatement to be low at the financial statement level. Financial statement level risk is low, and at assertion level, due to stable, established, relatively less risky business, extremely satisfactory internal controls operating in company. So they are saying that the financial statement level risk is low, controls are very good, business is very stable. However, despite low assessed risk, he chooses to send external confirmation request to third parties for confirmation certain material contracts entered with that. By doing so, he intends to obtain evidence regarding certain assertions contained in the financial statement. Do you think his approach in accordance with standards on auditing? So, they are saying that it's a very low risk audit. It is a very, very low risk audit. It is a very, very low risk. It is a very, very low risk audit. Okay. Financial statement level is low, risk is low, a very strong control, stable business. Then also is going for external confirmation. Then also the person is going for external confirmation. Okay. Then also it's going for external confirmation. Let's see, guys. It's a beautiful question. Beautiful question. Why it is beautiful question? November 23 mock, it has been asked, guys. November 23 mock, it has become very, very important. Very, very important. 330.100 is the concept. Okay, quickly, guys, let's quickly. So there are five things about SA 330. Five things about SA 330, and out of these five things, you are supposed to write two things. In this particular case, two things you're supposed to write. I will quickly explain you all the five things. Okay, number one, substantive audit procedures are mandatory for each and every material item. Substantive audit procedures are mandatory for each and every material item, transaction ban disclosure, irrespective of the risk assessment, whether there is risk is low or high, because risk assessment can go wrong. It is judgment based. Irrespective, irrespective of how good are internal control systems, irrespective of irrespective of irrespective of how good are the internal how irrespective of how good are the internal control systems, because internal control systems can be overridden by management anytime they want. So first of all, performing substantive audit procedure is mandatory. It is mandatory. This is what we are supposed to explain this case. Next, either you can perform only substantive analytical, either you can perform only test of detail, or combination of above. And then you explain something about analytical procedure and something about test of details. Then third, of course, there will be effect of test of controls. There will be effect of risk assessment and test of controls. We may do less checking or more checking, but checking is mandatory. That is the important message. It is mandatory to think about external confirmation. Yes, it is mandatory to think about external confirmation. If it is mandatory to think whether external confirmation is possible, and if it is possible, you have to go for it. It is mandatory to think carefully about the external confirmation. Okay. And last point, it is mandatory to have substantive audit process for closing process, for reconciling whether data in books of accounts and data in financial statement, they match with each other. And second, for material journal entries and adjustment at year end. Five things, guys. First of all, substantive audit process are mandatory for all material items. There are three ways of checking it: only analytical, only substantive, or combination of both. Third, there will be definitely effect of test of controls. If controls are weak, substantive procedure are more, and vice versa. It is mandatory to consider whether external confirmation is possible. And it should be performed. It is possible, it should be performed. Okay, quantum can be increased or decreased, but it should be performed. And closing process, for two things you need substantive audit procedure: one for agreeing the financial statements and books of accounts, and next for journal entries, material journal entries. Now, guys, in this question you are supposed to explain these 2 points, that number one, substantive audit process mandatory, and number two, it is mandatory to think about external confirmation. So the approach of CAY is absolutely correct. He is mandatorily going for substantive audit procedure, and in that also he is mandatorily going for external confirmation. Even that is the very appropriate thing. That is a very important thing. Okay, guys, we are through with that. So lovely question, guys. There were a lot of traditional questions, traditional theory. We went through that also, and we are through with one more chapter. So it's almost 4 lectures, and we are through with 4 chapters, guys. So guys, if you loved it, do like it, share it, and put your lovely comment. That matters a lot. Do put your lovely comments, guys.